What's up, everyone? It's Scotty with MoneyVest. So I think it's time for us to talk about Tesla's earnings. And I really wish that I could unsee them because the numbers were not that great. And look, you guys know, most of the people who are watching the channel, that Tesla is my biggest position. So I've got a little bit over 20% in Tesla stock. But that doesn't mean that I'm not going to call out the numbers that weren't that great, right? So if you're watching anybody else, if you are looking at anybody else's analysis and they try to spin these types of earnings that, oh, Tesla did really well, Tesla was good, they're either, again, lying to themselves, lying to you, or they just don't know what they're talking about because the numbers were not that great. And I'll give credit where credit is due, right? Tesla's dealing with a very tough macro environment. Interest rates are really high. And so the auto loan rates are hitting as high as 7 to 8%, which is exactly what Elon Musk also mentioned in the earnings call, that he's concerned and worried about a higher interest rate environment where the demand could taper off. And that's totally the macro environment, right? And that's what Tesla's dealing with right now. And they're still able to grow vehicle deliveries, but we have to address the bigger problem, which is price cuts, margins. That's really what's coming down, and Tesla stock is down a little bit over 5% pre-market at the moment. And my calls are going to obviously print. That's exactly why we take those hedge positions and sell cover calls, is to benefit from when the stock price does do something like this when it's down 5, 6, 7%. And yesterday, as I mentioned, that I was very surprised. The stock was only down 4% after hours, considering the type of numbers we saw. So hope you guys enjoy it and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel, and link to our Discord and Patreon is going to be down below. And, look, if you're here on this channel, if you're watching this video and you're expecting me to tell you that Tesla is going to moon and it's going to become this super massive $5 trillion company without backing it up with any thesis or everything's going to be fine, I'm sorry. This is not a channel for you. I'm going to give you the most brutal, unbiased truth and the objective analysis behind these numbers. So let's just dive right into it. And this right here is the spreadsheet. Now, what I want to really tackle on is a few things. Of course, the margins is going to be the big issue, so we're going to highlight that. We've got the average selling price. We're going to highlight that as well. And of course, we've got the gross margins, operating margins, and free cash flow more specifically is I want to highlight for the company. So automotive revenue, $17.7 billion in the third quarter 2022. And that was a little bit over $18.5 billion in the third quarter 2023, the numbers that we just learned from Tesla yesterday. And year over year, that's an increase of about 4.5%. So nothing crazy. Automotive cost, right? So in their presentation, they actually go over that cost is now coming down. So what they basically mentioned was this chart right over here that says cumulative miles driven. Of course, that's for FSD beta over here, which is now sitting at over 600 million miles. And this right here is the chart, right? Cost of goods sold per vehicle. And that's down from 39,500 to 37,500. Now, that's not a big change, but when you go further down into their financial statements, their cost of vehicles, cost of automotive sales was up on a year-over-year basis from a little bit over $13 billion to over $15.6 billion. That's a 19.5% growth on a year-over-year basis, and their quarter-over-quarter decline was 7%. So as we know, Tesla's been cutting prices, and that's exactly why average selling price, which is the ASP, that's come down from 51,700. This is simply taking into account automotive revenues divided by automotive cost. And I'm not excluding for any regulatory credits, any tax credits, none of that. I'm simply taking into account the actual deliveries Tesla made from revenue coming in from deliveries and the cost incurred for making those vehicles. And that's the average selling price. That's come down from $51,000, 51,700 to be precise, to 42,000. 42,000 now. That's the pricing mix for average selling price here for Tesla. That's down 2.5% quarter over quarter, and year over year down over 17%, right? So even though their automotive revenue is up with the price cuts, what's happening is that the price cuts that Tesla is doing are more aggressive than the reduction in cost, because cost is only down 7% quarter over quarter, whereas the revenue is down over 9%. And if you take a look at year over year, the increase in cost is more than the increase in revenue. That's obviously going to compress the margins. And that's why the automotive margins were down over 1,000 basis points, negative 10.6%. right? That is concerning, folks. I mean, we got gross margins now sitting at under 18%, and more importantly, operating margins at 7.6%. Now, Tesla's gonna start maybe potentially advertising and marketing campaigns as well. So that's not even included in these operating margins for Tesla, right? So I mean, you could start to imagine what that might look like from an operating perspective, operating basis. I mean, you look at Tesla's net income, bottom line, earnings per share were still solid. So again, if you come over to some of these numbers here, growth in vehicle deliveries, growth in other parts of the business, but reduced average selling price, negative foreign exchange impact. Maybe I guess that is something to do with the revenues as well. So again, it's not. I'm gonna give credit where credit's due to Tesla. About $400 million is a pretty big number when it comes to foreign exchange. And then our operating income decreased year over year to 1.8 billion, resulting in a 7.6% margin. And operating income was primarily impacted by the following items: reduced ASP, again, increase in operating expenses driven by Cybertruck, AI, and other R&D projects. That's understandable. In cost of production ramp and idle costs related to factory upgrades, we got negative foreign exchange impact. But the growth in vehicle deliveries, lower cost per vehicle, gross profit growth, and growth in regulatory credit sales as well. Cash and cash equivalents continue to go up. $2.3 billion increase, basically in free cash flow. And overall cash amount, I think, is sitting a little bit over $20 billion still. So balance sheet's still phenomenal. We'll go over the balance sheet in just a minute. And now production capacities are now approaching over 2 million vehicles. That's incredible. Shanghai alone can produce almost up to 1 million vehicles. And Texas going to be a little bit closer to 500,000. We got Berlin at 375,000, and then California just a little bit over 500,000 as well. So we are approaching, again, very, very nice consistent growth in production levels at over 2 million vehicles. And this, again, we went over earlier at over 600 million miles of FSD beta driven. So they've got a lot of data to work on autonomous driving. That's really where the valuation comes in. A lot of the valuation kind of rests on the back of the autonomous driving and FSD. And when it comes to volume, we're working with about a 50% CAGR target that they have, and they are reiterating that volume target. And 1.8 million is going to be for this year. So they need to hit over 400, I think 470,000 is what they need to hit in order to get to over 1.8 million. Yeah, so I think they're already at 1.3 million vehicles, 1.33 million vehicle deliveries for this year so far in the first 9 months, and getting up to another 470,000, I think, is gonna achieve that 1.8 million target for the company. So we have ample liquidity, and again, cash is sitting. And while we continue to execute on innovations to reduce the cost of manufacturing and operations over time, we expect our hardware-related profits to be accompanied by an acceleration of AI, software, and fleet-based profits. And I think this is really where the thesis comes in, right? So, look, Tesla for the longest time has had this concept in mind where they are going to lower prices, okay? So I have no problem in Tesla lowering prices. I have no problem in this average selling price coming down, because that's going to increase affordability, and that's going to make Teslas more affordable to people. But the only problem with that is that their revenue, their prices are coming down faster than cost, okay? So they're basically generating revenue that is declining because of price cuts, to increase demand so that install base grows, but that's also hurting the margins. So all of that is coming at the expense of margins. Now, in the future, it's possible that Tesla starts to reaccelerate. I can't tell you if that 7.6% operating margin is indeed the floor. I mean, it can get down to as low as 7%, sub 7%, 6% in the future quarters if, number one, interest rates don't come down fast enough, cost of production, cost of sales doesn't come down fast enough. Number three, Tesla continues to do these price cuts to boost demand, to kind of hit their volume targets and delivery targets. So those are some things. And number four, if services and artificial intelligence and FSD doesn't start contributing to the overall margin mix when it comes for Tesla. Because that's really where, again, a lot of the revenue, a lot of the profitability is resting, right? Similar to Amazon, Amazon's e-commerce, really, really low margins, but the fact that it's profitable on AWS kind of compensates for everything else, because AWS margins are very, very high. I think that's really where Tesla needs to be, is where, FSD and autonomous driving and solar and supercomputing and robotics, like all these kind of other aspects of the business need to be generating a higher margin so that Tesla can compensate for the declining margins in hardware, which is their vehicles. So that's where we are. Cybertruck deliveries remain on track for later this year. In addition, we continue to make progress on our next generation platform. But Elon Musk also mentioned that Cybertruck is not going to be cash flow positive, or significantly positive cash flow wise, from at least in the 12 to 18 months going into moving forward when the deliveries do begin in November 2023. So again, some beautiful Cybertrucks getting shipped out. This right here is the balance sheet. So balance sheet wise, I mean, Tesla's never really had any problems. I mean, cash and cash equivalents are sitting at a little bit over $23 billion I mentioned earlier, and their all liabilities are sitting at $38 billion, with long-term debt is going to be sitting right over here, debt and other net of current positions, sitting at about just under $900 million. So this is, again, one of the best automotive companies from a balance sheet perspective at the moment. And again, these are some of the numbers here. 66 cents per share coming in at 73 cents expected, and $23.3 billion in revenue versus $24 billion expected. So and again, these are some of the numbers that we went over earlier. Again, you can see the net income, so which is the bottom line, on a non-GAAP basis was $2.3 billion, down 37% year over year. And on a GAAP basis, it was at $1.8 billion, down 44% on a year-over-year basis. And their net margins, man, I don't even want to calculate what their net margins look like. 2318 is what we're looking at for their net income. So we can just put down net income over here, and net margins are going to be, for Tesla, this divided by automotive revenue, is looking at just a little bit about 12%. So this, again, is kind of taking into account non-GAAP numbers, and then GAAP number is going to be 1853. So 1853, we're looking at 9.97. So a little bit under 10% in net margins for the business. But again, this is not the pure vehicle profit, because it also accounts for the energy generation and storage revenue that's coming in at $1.55 billion in revenue, and other expenses also accounted for. So this is not your true automotive net profit. This is simply taking into account the entire companies, which again, on a non-GAAP basis, 12% is actually pretty good, reasonable, but it's still down from same time last year, right? And then on a GAAP basis, it's down under 10%, 9.97. So that's where we are, with Tesla, and right now pre-market. By the way, yields 4.975, so we're almost up to 5% here, and Tesla pre-market is down a little bit over 7% now. We just hit 7%, and again, it's not a surprise, coming down to 225s, low 200s. We were kind of watching that level, and I specifically mentioned that Tesla is going to be ready to make a big move. And the reason for that was because it was kind of consolidating sideways in this symmetrical triangle. So that's why we had, or basically I had covered calls, hedged my position on the long side. And we'll be looking at basically closing those out today. If any of them are up over 95, close to 98%, I just want them to be as worthless as possible so I can close out my positions in that sense. So that's where we are. Tesla down 7%. I think it's gonna be quite an interesting day. But let me know your thoughts down in the comment section below. As always, if you enjoyed it, find it helpful, make sure that you drop a like, subscribe to the channel. Again, this is not a hit piece on Tesla. I'm long on Tesla. It's my biggest position, so I'm bullish, optimistic long term. But I gotta call it how it is, and got to give you my unbiased objective analysis, where the numbers were not that great. On a year-over-year basis, quarter-over-quarter basis, we are declining, unfortunately, on the back of price cuts and revenue going down faster than cost at the moment. So that's where we are. Let me know in the comment section below. Happy investing. I'll see you all in the next video.